What if Apple announced tomorrow that it had just acquired $20 billion worth of Bitcoin for its corporate treasury? Stop for a moment and truly consider the implications. The market wouldn't just move, it would detonate. A financial shockwave would ripple across the globe, making every previous bull run look like a minor tremor in comparison. And according to insiders at the very heart of institutional finance, this is no longer a wild speculative fantasy. This exact scenario is being actively discussed and wargamed in the highest echelons of corporate power. We are standing on the brink of what could be the single greatest and fastest wealth transfer in a generation. A seismic shift driven by the world's most powerful companies, the Magnificent Seven. These tech titans, Apple, Microsoft, Alphabet, Amazon, Nvidia, Tesla, and Meta, are not just companies. They are nation-states of capital, sitting on literal mountains of cash, hundreds of billions of dollars, that are slowly but surely being eaten away by the relentless acid of inflation. And they are beginning to view Bitcoin not as a speculative gamble for retail investors, but as an essential strategic asset for corporate survival and growth. Today, we're going deep behind the closed boardroom doors to decode this silent but earth-shaking revolution. We'll investigate precisely why these giants are now seriously considering a move that would have been unthinkable just a few years ago. We'll hear from a top executive at a leading Swiss digital asset bank, Fabian Dori, who confirms from the front lines that these conversations are very, very real. We will explore the fundamental and critically important differences between Bitcoin and Ether and why institutions are developing sophisticated strategies for both. And finally, we will confront the multi-trillion-dollar question. What would actually happen to the price of Bitcoin if even one of these giants decides to pull the trigger? This isn't just another crypto story. This is a story about the future of money itself. The path was forged by a pioneer who was once seen as a madman. That man is Michael Saylor of MicroStrategy. He took his publicly traded software company and radically transformed it into what is now, for all intents and purposes, a leveraged Bitcoin holding company. For years, the titans of Wall Street and conservative finance columnists viewed him as a reckless outlier, an eccentric gambler betting the entire farm on digital magic beans. But time has a funny way of turning rebels into prophets. Saylor's argument was brutally simple and, in hindsight, remarkably prescient. Holding large amounts of cash on a corporate balance sheet was no longer a safe conservative strategy. It was a guaranteed loss. In an era of unprecedented monetary expansion by central banks and persistent global inflation, cash was a melting ice cube. Corporate treasuries, traditionally parked in cash, money market funds, and short-term government bonds, were no longer safe havens but bleeding assets, losing purchasing power every single day. He chose Bitcoin as his primary treasury reserve asset because of its one unchangeable, godlike property: absolute scarcity. There will only ever 21 million Bitcoin. No government committee can vote to print more. No central bank chairman can conjure more into existence to bail out an ailing system. It is, in his famous words, a superior vessel for storing monetary energy over long periods. While the rest of the corporate world watched with a mixture of horror and fascination, MicroStrategy began to accumulate Bitcoin relentlessly. Today, they hold over 200,000 of them. And what happened to their stock price? It soared, proving a critical point. Shareholders were not just accepting of this strategy, they were hungry for it. Now, the seeds of that revolution are beginning to sprout in much larger, more conservative fields. The man confirming this trend is Fabian Dori, the chief investment officer at Sygnum, a fully regulated Swiss digital asset bank. It is crucial to understand what Sygnum is. This isn't a crypto startup. It's a bank with a Swiss banking license, operating with the same regulatory oversight as centuries-old private banks in Zurich and Geneva. They cater specifically to the needs of institutional and high-net-worth clients, the smart money of the world. In a recent interview, Dori laid out the case with chilling clarity. He revealed that while Tesla is the only member of the Magnificent Seven to have officially and publicly disclosed Bitcoin on its balance sheet so far, several of these other multi-trillion-dollar firms have been actively and seriously exploring it as a way to diversify their vast treasuries. The rationale, he explains, is multifaceted and compelling. First, there's the growing and increasingly loud interest from their own shareholders. These investors see the outperformance of companies like MicroStrategy and are beginning to ask their boards some very pointed questions. Why aren't we holding $50 billion in assets that are losing value to inflation? Why aren't we taking a small, prudent step to protect that value with a digital asset? Second, the arrival of spot Bitcoin exchange-traded funds, or ETFs, has completely changed the game. It created a regulated, familiar, and incredibly simple pathway for corporations to gain exposure without the immense technical and security headaches of direct custody. A company like Apple, with its fortress-like approach to security, no longer needs to build a team to figure out how to securely store billions in crypto. They can just call Larry Fink at BlackRock or Abigail Johnson at Fidelity and buy their ETF. The operational friction has vanished. And third, the core property of Bitcoin, its mathematically fixed supply, becomes exponentially more attractive as global sovereign debt balloons to unsustainable levels and fiat currencies around the world show signs of structural weakness. Dory points out that for these cash-rich tech giants, allocating even a tiny fraction, say 1 to 3%, of their treasury to a non-sovereign, decentralized global asset is no longer a radical move. It is becoming a matter of prudent financial management. It's a hedge. It is, in effect, a form of insurance against the potential instability of the very global financial system they dominate. But the institutional interest doesn't stop at Bitcoin. This is where the story gets even more nuanced and fascinating. Dory highlights a crucial distinction that sophisticated investors are now making between the two giants of the crypto world, Bitcoin and Ether. To simplify, think of it as a strategic choice between acquiring digital gold and investing in digital oil. Bitcoin's value proposition is pure and simple. It is rooted in its profound scarcity and its emerging role as a global, non-sovereign store of value. It's designed to do one thing exceptionally well: preserve wealth across time and space. Its protocol is essentially finished. It is robust, hardened by over a decade of attacks, and secured by the most powerful computer network in human history. Institutions look at Bitcoin and see a final, incorruptible settlement layer for value, a digital asset that isn't controlled by any single entity, making it the perfect hedge against inflation, currency devaluation, and geopolitical risk. It doesn't generate a yield, and that's a feature, not a bug. Its value is its very existence as a pristine, unprintable, politically neutral asset. If you're finding this breakdown of institutional strategy valuable, do us a solid and hit that like button. It tells our team you want more deep dives like this and truly helps the channel grow. Now, let's talk about Ether, the native token of the Ethereum network. It is a completely different beast. If Bitcoin is the inert, beautiful, and scarce digital gold, Ether is the dynamic, productive, and essential digital oil that fuels a new global economy. Ethereum is a programmable blockchain, a decentralized world computer that allows developers to build unstoppable applications. From decentralized finance, or DeFi, which aims to rebuild the entire financial system without intermediaries, to non-fungible tokens, or NFTs, which are revolutionizing digital ownership, and the entire infrastructure of what we call Web3. Ether has a compelling dual identity that makes it incredibly attractive to institutions for different reasons. On one hand, it functions as the gas needed to power transactions and execute smart contracts on the network. Every action on Ethereum requires a small payment in Ether. On the other hand, through a process called staking, holders of Ether can lock up their coins to help secure the network and, in return, earn a real yield. This is transformative. It turns Ether from a passive store of value into a productive, yield-generating asset, almost like a digital bond that pays a regular dividend. For an institution, it's an investment in the foundational infrastructure of the next generation of the internet, a bet on the growth of this entire ecosystem. So, for a corporate treasurer or an institutional fund manager, the choice isn't necessarily Bitcoin or Ether, it's about defining their objective. Do they want a pure, non-correlated store of value to act as an anchor and protect their treasury from macroeconomic storms? They allocate to Bitcoin. Do they want exposure to the explosive growth of the burgeoning Web3 ecosystem and an asset that can generate a productive cash flow? They allocate to Ether. It's a fascinating strategic dilemma, choosing between the unyielding stability of digital gold and the productive potential of digital oil. The real game changer that has unlocked the door for all of this corporate and institutional interest, the key that turned the lock, is the Spot Bitcoin ETF. For years, the lack of a regulated, accessible investment product was the single biggest barrier to entry for big money. Corporations, pension funds, and endowments operate under strict fiduciary duties and complex compliance rules. They couldn't just open an account on an offshore crypto exchange and hope for the best. The approval of spot Bitcoin ETFs by the U.S. Securities and Exchange Commission in early 2024, led by the world's largest and most respected asset managers like BlackRock, Fidelity, and ARK Invest, was a watershed moment. It provided a powerful seal of legitimacy, and more importantly, it built a sturdy, trusted, and insured bridge from the world of traditional finance directly into the heart of the digital asset ecosystem. Now, any company's chief financial officer can gain exposure to the price of Bitcoin with a simple phone call to their institutional brokerage, using the exact same financial plumbing they use to buy stocks, bonds, or commodities. The early success has been nothing short of staggering, with these ETFs seeing tens of billions of dollars in net inflows within just the first few months, proving the immense and previously trapped pent-up demand. This brings us to the ultimate question, the explosive climax of this entire story. What happens if the Magnificent Seven actually start buying? Let's run some very conservative hypothetical numbers. The combined cash equivalents, and short-term investments held by these 7 companies is well over $500 billion. Now, let's imagine they decide to follow a prudent diversification strategy. Not the aggressive Michael Saylor approach, but a simple, conservative one allocation of that cash hoard to Bitcoin. That would be an immediate, overnight injection of over $5 billion of new, sticky demand. A 5% allocation, still a modest diversification for a portfolio of this size, would unleash over $25 billion. But here is the critical part to understand, the part that makes this scenario so explosive. Because of Bitcoin's perfectly inelastic supply, this new demand would have a vastly disproportionate, non-linear impact on its price. There are not scores of new Bitcoin being mined every day to meet a surge in demand like there are with new shares of a company being issued or more barrels of oil being pumped. The supply is fixed and known. The new Bitcoin entering circulation is algorithmically tiny and programmatically decreases every 4 years in an event known as the halving. What this means is that billions of dollars of corporate treasury demand would be chasing a very small and continuously shrinking pool of available Bitcoin for sale on exchanges. The vast majority of the 21 million coins are held by long-term believers who are not selling. The result would be a catastrophic supply shock. Prices wouldn't just rise steadily. They would likely go parabolic as a global chase begins for the few remaining liquid coins. Each public announcement from a company like Apple or Microsoft would trigger a massive wave of front-running from hedge funds, other corporations, and even sovereign wealth funds, further amplifying the effect. It would create a powerful feedback loop, a brutal game of corporate fear of missing out, or FOMO, where the companies that wait would be forced to buy in at exponentially higher prices. We are witnessing a pivotal shift, as Fabian Dorey puts it. Digital assets are transitioning from purely speculative instruments to strategic financial tools in the eyes of the world's most sophisticated investors. The narrative has evolved from a retail-driven phenomenon to an institutional-grade asset class. The question is no longer if a major tech giant will make the next move, but when, and who will be the first to follow Tesla's lead and cross the Rubicon. The dominoes are lined up, each one representing hundreds of billions of dollars in purchasing power. The first one to fall won't just make headlines. It could permanently alter the landscape of global finance and redefine the very concept of a corporate treasury for the 21st century. Which of the Magnificent Seven do you think will be next? Let us know your prediction in the comments below. And if you want to stay ahead of the curve on the future of finance, make sure you subscribe and hit that notification bell so you don't miss our next investigation.